I'm Sandy Weaver with Weaver Financial. Let's do the numbers. In a nutshell, in the first quarter, bonds lost unprecedented amounts and stocks lost money too. COVID receded from the headlines and hospitals. Russia's war on Ukraine shook the nation as war returned to our world. The Federal Reserve reversed course and increased short-term interest rates 0.25%. U.S. large companies corrected down 10%, then revived to lose 5%. U.S. small company stocks dropped 8%. Overseas stocks lost 5%. Bonds lost an astonishing 6%, a big move for that asset class. Corporate earnings on U.S. large companies grew by 30% in the fourth quarter of last year, and they're projected to grow by a modest 5% for the quarter we just finished here. Earnings growth was an amazing 45% for all of 2021, but that's due to COVID measures. Businesses are still doing well in the U.S. Supply chain issues are starting to ease. Inventories are building again. Earnings growth for all of 2022 is predicted to moderate to 9%. The U.S. economy is performing well. U.S. gross domestic product grew 7% in the fourth quarter and 6% for 2021 all told. A 3% return to normal is projected for 2022, so half of that. The unemployment rate has again dropped to an ultra-low 3.6%. It was 3.5% pre-COVID. People are returning to the workforce. Average hourly earnings rose 5.6% in March, but inflation per CPI is running 8% or more. Most of these numbers are great, but the markets are down for the quarter. Why? It's mostly the Fed. They reversed interest rates in March, which were at 0%, and they stopped adding liquidity to the system. The Fed is taking away the punch bowl. They have two goals. First is to control inflation. The second is to get to full employment. A 3.6% unemployment rate is darn close to that. But I probably don't need to tell you that inflation has spiked from our normal 2% up to 8%. You can see that and worse at the grocery store. Most pros expect the Fed to increase the short-term interest rate to 2% from 0% by year end, with more rate hikes to follow in 2023. Equally important, but not that well defined yet, is what happens to the Federal Reserve Bank's $9 trillion balance sheet, which is money they used to stimulate the system the last couple years due to COVID. Most expect the Fed to pull out 80 to 90 billion each month. That tightens conditions a bit, just like an interest rate hike. Both actions should fight inflation. Such tightening eventually moderates business growth, but it can cause a recession, defined as 2 quarters of negative growth, if it's done too much. There are delicate tweaks. These are a bit like brain surgery. Does the war impact our economy? Yes, it does, but not as much as the Federal Reserve's actions. You've seen the spikes in energy due to the war. You've seen the spikes in some agricultural commodities. The war impacts our values and morals perhaps more than our stock and bond markets. What's happening internationally? Central banks over there started increasing their interest rates before we did. The war has impacted their areas more than ours, especially in Europe. Their markets are down roughly 5%. Asian markets are not faring any better. China has locked down some of its larger cities due to their COVID cases. Japan is still closed to tourists due to COVID. Bottom line, we're into 2022 now, and growth is slowing, and companies will have to be more nimble to succeed. The markets, both bonds and stocks, will be volatile because of the Federal Reserve's interest rate moves and the war. The stock market's value has dropped to 19.5 times forecasted earnings, but that's still above average. Last quarter, I wrote that interest rates on the 10-year Treasury note made a startling move from 1.5 to 1.7%. Boy, was that an understatement. The 10-year has now jumped up to 2.6%, and its price has fallen commensurately. What's our best case for this year? We'll have modest growth in earnings and stock prices. What's the worst case? Very few pros predict this right now, but it's that the Fed will mismanage and tip us in a recession, hopefully a short one. We've employed diversification in a variety of solid quality investments in your portfolios to navigate through. Plus, we've built reserves for upcoming spending needs. Thank you for your interest. I hope all the numbers weren't too mind-numbing. Please call or email if you want to dig in further. I'm glad to pass on articles I've read.